I'm excited to have Oren, and I'm going to get this right. I'm going to get this right. I promise you. Barzilai. Right?
Barzilai.
Close. Man, I don't know why I
Barzilai.
keep messing it up. I'm an idiot.
No.
And CEO, one of the co-founders of EquityBee, and I'm going to pass it off to you because I've been so excited to speak with you. There's so many people now, given what's happening in the economy, with stock prices cratering, with people in the tech sector on Wall Street, other areas worried about their stock and their stock holdings and what do we do? And I thought you would be like the perfect person to give a high level view of what's going on. And I know you can't give any financial advice, but just kind of big picture advice. What are the options? So maybe with that in mind, you could maybe tell a little about yourself and EquityBee.
Of course, Jack. So first, happy to be here. I think it might make sense to start with a quick introduction of what we do at EquityBee to better understand what we are doing and where we are coming from. So at EquityBee, our mission is to empower all startup employees to participate in the success of the companies they have built. Now, it sounds quite trivial, right? You join a startup company, you get some stock options, equity, the company grows, you join the right company at the right time, and then the company goes public or exits, and you get your piece of the pie. It sounds very trivial. The reality, unfortunately, is very, very different. In the first part, employees join startup companies. They don't really have the knowledge, in most cases, or the tools to join the right company at the right time. And while employees negotiate their salaries, they don't have the tools or the data that they need to really negotiate their equity. And 5-10% higher salary can be a nice thing, but 5, 20, 30% higher equity can be a life-changing event. Owning the right equity, the right company can be a life-changing event versus a slight increase in your salary, which is not likely to be. So that's the first thing. When they join the company, employees don't have what they need to select the right company and negotiate properly their equity. Then after they join the company, they work the right company, they created value for the company. The average employee today in Silicon Valley and the US, the average startup employee, they will spend about 2.5 years in a company, while on average, it will take for a company about 12 years from inception to an IPO. It means that most of these employees will switch several companies during that time and will not be there for the entire journey of the company. And the problem is that even if you joined the right company at the right time and got some equity, if you will decide to leave, or if the company will decide it's your time to leave, it doesn't matter, you will have a limited amount of time to exercise your stock options. So assuming you joined the right company at the right time, say that you need to pay now out of pocket once you're leaving to exercise and pay the applicable taxes, $200,000 to buy an asset that is valued today at $600,000 to $700,000. It should be a no-brainer. You pay 200, you get 700 back. But what you're actually getting is an illiquid asset that is not tradable, that you'll need to wait now for the company to go public or exits. Most startup employees don't have the cash, and even if they do, they cannot afford the risk of invest their life savings in one illiquid startup company, especially they cannot do that every 2.5 years. And because of that, the majority of startup employees do not exercise the stock options and fail to participate in the success of the companies they have built. So this is the problem that we are trying to fix in the market. And that's where we are coming from. And the way that we do that is because we want to provide employees with the best deal possible. And at the same time, we would like to provide access to investors to these great companies. We've built a platform that employees can come to the platform, sign up, say, hey, I'm worked at this company. That's my equity grant. And from the other end, we have a community of investors offering them the capital they need to get the money they need to exercise the stock options or to even receive some liquidity in different cases. And yeah, and eventually participate in the company, to participate in the success of the company they help build. So that's what we do at EquityBee.
So Oren, to take a step back, the first piece you talked about is you join up a startup and then you have a decision, do I take equity or not? Can you walk us through that? Do all employees, or for the most employees, when they go to a startup, do they have the option of getting stock grants, RSUs right away, or they have to be there for a certain time? And then how can they decide how much, or do companies allow you to decide for yourself, I rather have less salary and more equity, or vice versa?
So most startup companies offer equity because that's the incentive for you to join the startup company to get your piece of the pie once the company becomes successful. So that's very common to offer equity. The wild card is that most companies just tell you, hey, you're going to get 5,000 stock options, 10,000 stock options. And that number is meaningless. It's very arbitrary. A company can decide how many shares do you want to have. One company decides to have 1 million shares, and the other company decides to have 100 million shares. It's meaningless. So that number alone of how many stock options or you're being granted with is completely meaningless. You need to understand what is the dollar value, the current dollar value of that equity grant. Most companies, not because they are evil, they don't share this information because employees don't know to ask for it.
So if you ask, they would tell you for the most part and say, hey, if you want to take, stock, the stock it's private. We didn't go public yet, but it's based $5 per share. So stuff like that.
I wish it was that simple.
Okay.
I wish it was that simple. If we would speak, I would say a year ago, back in 2021, before the market plummet, in most cases, employees should have asked, what is the last price investors paid? Because it wouldn't be a share price that investor paid, because that would have been a good anchor for the current value of their equity grant. Today, after the market changed, it's not as good, but that's likely to be, at the moment, at this time, the best thing employee have to ask. So they need to ask, what is the current dollar value of this equity, the equity grant I'm being offered? And usually that equity grant will be over a period of time. Usually it's 4 years, and that as long as you're working with the company, and that's fine, that's standard. But to have an offer of 5,000 stock options from company A and then 50,000 stock options from company B, you can't just compare the number. You need to understand the dollar value. So you need to compare dollar value. That's the first.
I don't mean to interrupt, but so let's say you take the option where you want to get more stock, relative to your salary. Do you have to lay out any money right away, or no? Or it's just an obligation down the road to pay for it, to convert it?
So the way that stock option works is that you get a stock option with a strike price. It means that once you would like to turn it into a share, you need to pay the strike prices, to pay the strike price and applicable taxes on the theoretical profit. So if you own stock options and the company exits in a higher value than your exercise price, your strike price, that is very simple. You receive money, you pay back the strike price, and you actually your profit is the difference. But
do companies, and I'm sorry, I just want to make sure. So for the listeners, because this is really important information, do they offer guidance internally at the company to help you walk it through, or you as an employee on your own have to figure this out and do your homework?
We've seen some companies provide this guidance, but it's not the common case.
Really?
I wouldn't say it's very rare. but most companies do not provide this guidance because many employees simply don't ask. Many employees, because they don't know and they don't have the, very smart, computer science graduates from top tier universities, they just don't ask. They ask, what is my salary? What are the benefits? What kind of food you guys offer? But they don't really dwell on the equity part, which is very unfortunate because owning an equity, the right company, the right time can and will lead to a life-changing event. Okay? All of the other stuff that I just mentioned will not. And because this market is very opaque, you can see huge differences between the value of equity grants. Some companies can offer 3 or 5 times more than other comparable companies, while you will not see such differences with cash compensation, because it's not as, because it's opaque, because people don't have ways to compare, and usually they cannot put dollar value in front of it. So to compare dollar value is very easy, but to compare equity value, it's harder, because first, most employees don't ask, so they don't even know what is a dollar value. And then how would you compare? You're not a professional investor. You have to say early stage company, Series A stage, okay? And you are comparing these two companies. One company can be very, top tier investors, growing fast, and all of the top tier VCs of Silicon Valley would like to invest in that company. Versus the other company, the Series A company, it might be successful in the future, but right now it's not doing very well. For employees that are not, that for developers or for marketers, for product managers, in most times, because they are not professional investors, they don't know how to ask these questions. Specifically because of this, in order to help employees to make more educated decisions, we released the most sought after startup companies by our investor community. Not because we believe that if a company is there, it means that it will for sure be successful, but we believe that it's a good signal that if many professional investors seek access to a specific company, it's a very good signal that that company has a better chance or higher probability to be successful than companies that investors don't seek access to. Again, it's not bulletproof, okay? Things change. The companies that were very sought after in the past, not necessarily the same today, but I believe it's a good signal. And that's exactly why every once in a while, we release this survey, and just recently we've released the top 100 startups demand within our platform based on our investor community.
That makes a lot of sense, because this way you could give some metrics to decide, how do I figure out where I stand? And if you could compare it to say, hey, if you have Sequoia and you have, Tiger funds or whatever it may be, and here's their track record of success. And then I'd imagine also what field you're playing in. Is it biotech? Is it, what type of startup is it? And then I imagine you need to have the, kind of the data and the information, which ones have a faster growth chart. Is it a SaaS kind of company or what have you? And then it could help people make a more intelligent decision, right?
Correct. And exactly because of this, because we know that many employees actually say, I'm into fintech, I'm limiting my search only to fintech, or I'm into biotech, so I want to work only in biotech companies. So within this, we call it the EquityBee 100. And within this, we released the full top 100 companies, most sought after by investor community. And we also break it down into different verticals. These are the top 5 in fintech. This is the top 5 in biotech. These are the top 5 in data, in big data, or enterprise software. So if, as an employee, you are into a specific vertical, you should make your educated decision. And I'm not saying that you necessarily need to go to the most sought after company, but if you're going to less known or successful company at the moment, it means that the risk that you're taking is higher. So the equity compensation that you should ask, it's a good argument to say, you know, I have another offer from this company that right now seems to be more promising. I believe in your company, I would like to join, but because of the higher risk, I'm asking for more equity. And I think it's a very good argument to have once you're negotiating for your equity package.
Or in this kind of market where we see with layoffs, FYI, I think what they have like 150,000 people in tech and startups were laid off. Do companies now offer more equity or less, given that we're in a tougher contracting economy, possibly going to recession?
Yeah, so it's still early to say because I can't know for sure what companies are offering, but on anecdotes, I've seen actually on anecdotes and, you know, within my inner circle, I've seen companies now offering more equity because first, companies are now more sensitive to cash. So it's easier for them to offer equity. That's one. Also, as a CEO, I can tell you that when I see employees negotiating for more for equity than cash, I believe that it's because they believe in the company more, and I appreciate it. So it's a good signal for a promising candidate. And last, the thing is that the way that equity works is that equity is being granted. The strike price is determined based on the current fair market value of the company. Okay, and it's called 498 or fair market value, and the fair market value is determined once every time, at least once every 12 months, or earlier if there is a major event in the company, like a funding round. Now that we are almost soon a year into the economy slowdown, I guess that by April or May, all companies will have an updated fair market value. Most companies actually took leverage of the current market and voluntarily updated their fair market value to lower their fair market value in order to benefit their employees. Okay.
Wait a minute. So in other words, not calling out any company specifically, they may write down the value of their company. During 2021, everybody wanted to be a billionaire unicorn company and say, look how great we are. Maybe now it's different. Everyone kind of brings it down so that, but they still feel the company has a lot of growth. So then the people who get equity have a better chance of making more money on it, right?
Exactly. And we've seen some, you know, headlines with different publishers, you know, company X slashed their valuation because of the market. No, so and these headlines are misguided because companies have strong incentive to lower their fair market value in order to benefit their employees. And especially now in the current market, they can lower it even further. So when providing grants to employees, they can provide them with lower share price, or lower strike price, and benefit them even more. I'm referring to private companies only, and it's very important to understand. Like, I'm not an investment advisor, and it's very hard to make predictions, especially about the future. And I don't know I don't know. I'm not a professor of economy, and I'm not an economist, and I don't know how 2023 or 2024 will look like. What I do know is, because the way that it works, as with comparables to the public market and to funding rounds, now companies can lower their fair market value further. And if we're trying to see what happened in the past, the last crisis, 2008, investors who invested right after the crisis, that vintage was very, very good, one of the best. Okay, so if we believe that history will repeat itself, investors who will invest right now are likely to generate very, very good returns. Now, what employees need to understand is whenever they join a company, so for investors, it's quite obvious, right? They understand that the current equity prices are way cheaper. And if history will repeat itself, they will increase. So now it's a very good time to make investments. What employees need to understand is whenever they join a startup company and they get equity, they're actually making an investment in one single company, the company they're working for. So right now, it might be a very, very good time to seek a role with a significant equity grant, or to approach your current employer if you're a big believer in the company and say, hey, did we update our fair market value? The market changed. I'm still here, but I would like to get a refresh grant. Okay, to make sure they get the most out of the current market.
And how does that work? Are companies generally open if let's say I really believe in ABC widget tech company and I feel it's awesome, and I recognize that market conditions are not good now, but I'm confident they're going to improve in a year or two. So I want to like Warren Buffett, you buy it when it's cheap. You want to be a value investor. So can you just go to your boss, or you go to HR, or go to, like, who would you even go to within the company to say, hey, how do I get a refresher? How can I get more? And to get it, do you have to give up anything, or would they gladly hand it to you? How does that work?
Yeah, so it's equity grant is part of the benefits, right? So as you should go to the same person that you would discuss your compensation with, okay? And I believe, and that's what we follow at EquityBee, that companies should provide refresh grants on a regular basis. Because as I said, you join a company and usually you get your equity grant for 4 years. What happened after 2 years in the company? So you're 50% vested, okay? So what will happen in the next 2 or 3 or 4 or 5 years? So what we believe is that you should get new grants on a regular basis to keep you incentivized in the company, and make sure that those who stay longer with the company will have significantly higher equity holdings in the company. So some companies like EquityBee, for their employees, do it on a regular basis. And other companies don't, but I would encourage employees to just ask. Worst case, the company will just say no, and you'll be able to make your decision if you like to stay or not, okay? But I think especially in times like this, it's a very legitimate request to get a refresh grant of equity from the company that you are building.
And similar to what you said earlier, I'm not a financial advisor giving financial advice, but it's well known within Wall Street and investing is to dollar cost average, because you don't know, are you buying, like for instance, if you buy Amazon now, it's down, I don't know, let's say 40%. I'm not sure off the top of my head. I know that's publicly traded. So this is an investor in a publicly traded company. You may say, you know what, maybe I'll buy X amount now. Perhaps it'll go lower. Then next month I'll buy the same amount lower, and then the same amount lower, and then keep doing it for a while, because you're not sure, because most people can't guess the top and they can't guess the bottom. Yeah. So like if you kind of do it on a regular basis, now can people do that at their company? Say, hey, listen, I could get a certain amount of options, stock grants and refreshers, but space it out over time, because I don't know, maybe things are good, maybe things are bad. Does that?
Yeah, so what you were referring to is to the public market, and the public market right. price itself, on a regular basis. You can right. go to see the Google price, and it will probably change. The Google stock price will change a few times a day, right? Every second it's changing. So what you are referring to makes sense to not try to time the market. Nobody knows how to time the market. However, in the private market, as I mentioned, the price does not change all the time in real time. Companies need to actively go to a third-party appraisal and tell us that based on the current market comparables and our financials, what is our current fair market value? And they need to do this process at least once a year, or every time the company goes through a major event. Okay, a major event can be a funding round, and they can do that voluntarily because they say, okay, the market just crashed. Say, I just said Google before, say that the best comparable for our company in the public markets is Google. They just dropped, I don't know how much, 30%. So I will be able now to go to my provider and lower my fair market value because of this. So as an employee, you can ask your employer, hey, when is the last time that we got a fair market value? It shouldn't be the fair market value of the stock price and the time that it was given or determined should be known information for all team members. Okay, and based on that information, you can ask for an equity grant. So if I would work at the company X right now and ask for another equity grant, and they would offer this with a specific strike price, and I would learn that now we are in January 2023, and that happened last time in February 2022, just before the market plummeted, I would ask, okay, I prefer actually for you guys to have an updated fair market value, which is likely to be way lower. Again, likely, some companies did very, very well during this year, so their market value will be higher. But in most cases, it's likely to be lower because of the severe change in the market.
Right.
And then get a lower strike price, a lower exercise price. So the exercise price will be significantly lower for the same equity grant.
Now, Oren, you mentioned, and I've seen this as well, where particularly the Silicon Valley, there's a huge turnover rate. As you mentioned, 2 years, 3 years, 4 years, maybe 1 year being in a company and moving on.
Mm-hmm.
Do you walk away from it if you leave too soon, or how does that work for people to know if you kind of switch jobs? Do you leave it on the table, or some of it on the table, or can you take it with you?
So the standard for stock options is that you get it vested over 4 years, right? The standard is usually that the first 25% is after the first year, and then you get it monthly or quarterly. Okay, so let's assume that you joined company X and you received 100 stock options, and you work at the company for 2 years, so you are vested 50%, which is 50 stock options, right? So if you are leaving, you will not get the 50 shares that are still not vested, but maybe you're leaving for a different company and you'll get their shares instead. So maybe it's worth it because you'll hedge your risk with 2 different companies, and maybe the other company is more promising. Maybe that makes sense. However, what about the first 50 shares that are already vested? In that case, once you're leaving your company, you will have a limited amount of time to exercise the stock options. Usually that amount of time, if these are incentive stock options or what you're referring as ISOs, is by law limited to 90 days. So within 90 days, you need to pay out of pocket the strike price, which is known once you join the company, assuming that you have 50 stock options and the strike price of, say, every stock option is, the strike price is $1, so $1 times 50, it's $50. However, you also need to pay the taxes on the theoretical profit between the strike price and the current fair market value of the company right now. So if you joined the right company at the right time, and the company did very, very well, it means that the fair market value increased significantly. And that portion can be actually very, very high. We've just released the our annual State of the Union for 2022. And I think the average exercise price or the median was anywhere between $50,000 to $80,000, but that's without the taxes. Okay. I think one of the first employees that we launched EquityBee in March 2020, just to give you an example, and we launched EquityBee in the US in March 2020, and one of the first employees we've supported, he was a front-end developer who joined the right company at the right time, a consumer company, a known consumer company, but not one of the hottest high-flying company, but a good company. He joined, and if I remember correctly, the strike price portion was about $50,000 and the tax portion was about $700,000. So that employee needed about $750,000 to exercise his stock option. He joined the right company at the right time, and because he joined the right company at the right time, the company did so well, the tax portion was so significant that he couldn't afford to exercise. So it's about a bit counterintuitive that if you join the right company at the right time, your likelihood of be able to exercise out of pocket without solutions such as EquityBee is almost impossible.
And you would provide an introduction, if I understand, to investors so that in that scenario where a person doesn't have the financial means to hit that strike price and take the stock with them, you could connect them with people who could loan you the money, right? Or like lend the money so that you could buy it. And so in addition to the taxes and whatever profits that you have to pay, in taxes, you have to just pay off the loan, but you have that stock.
No. So first, very important, it's not a loan, it's an investment. And what we do, we have a platform. We don't introduce you directly to the investor. EquityBee is the broker that administers everything, and the investors don't know who the employees are, and the employees don't know the investors.
Okay, because it wasn't clear for that. So you have investors, but you're not sure who the investors are, but they would allocate the resources that you could effectuate the acquisition of that stock, and you don't have the money out of your own pocket.
Yeah, the way that it works, even if if you don't have the money or you can't afford the risk, say that you just you're about to leave or just left company X, you have 90 days to come up with, say, $500,000 or even less, even $50,000. Different. It varies a lot, but for the sake of the conversation, say $500,000. You will approach EquityBee. You say, I just left company X. This is my strike price. This is the terms. That's the company, and we'll tell you based on our investor community, their demand is that for your company, we will be able to front you the money, say $500,000, including to cover strike and taxes, to cover everything. So you will not need to pay anything out of pocket. And in return, upon a liquidity event, and only upon a successful liquidity event, you will pay back the investment amount, annual interest, and a certain percentage of your shares. That percentage can be as low as 5% or as high as 45%. It really depends on the specific company that you're coming from and what is the demand for this company at this price that you have from the investor community. Now, if for some reason the company did not do as well, or failed to go public, or never exited, or exited in a lower amount, the employees will never pay out of pocket. So they have zero out of pocket risk. They'll get all the money they need to exercise the stock options and potentially participate in the future success of the company they help build. But for this money, that the capital that they received from the investor community, they will share a portion of their future upside.
It's interesting. And the way you're walking us through this, I'd imagine that there are a lot of people out there at various companies who probably just walked away from this because it just gets too complicated. They didn't know what to do. Have you seen a lot of those stories where people, I could have, oh my gosh, I was in early on Uber, but I didn't have the money and I just, I didn't think it was going to go anywhere. I'm just giving it Uber's example, whatever it could be.
I've seen such examples also with Uber. about 55% of stock options goes unexercised every year in the US. So more than about 55% of stock options goes unexercised. And because of the example I just gave you, if you join the right company at the right time, the likelihood of you able to exercise out of pocket is impossible. So because if you, on average, if employees switch roles every 2.5 years, and on average, if you need to pay every 2.5 years an exercise cost that is higher than one annual net salary, nobody can afford it. It's structured in a way, the system is broken in that way.
It's almost geared towards the people who are the VCs who have a crazy amount of money, or the senior folks who have a lot of money and they could do it. But for the regular people, it's really hard, right?
I wouldn't, you know, I don't want to put blames because mostly it's tax structure,
Yeah.
okay, and that's the way they structured it. So it's not specifically about, you know, it's built for a specific group of people, but that's the way that it built. And for employees that can take the risk or can afford the risk, that's great. But for those who don't, for those who don't, I think our solution is critical. And you know, I'll just give you an example how important it is. Let's assume that you and I, you know, we grew up together. We are best friends. We went to the same, you know, kindergarten, then school, and then we went to the same college. We both got our computer science degree and joined the same company. We worked hard, and after 4 years, we got our stock options vested, and we decided to leave together to another company. We're exactly the same. We have exactly the same, you know, career trajectory. We did the same, and so in theory, we should earn the same money, right? But then when we decided to leave, we need to pay out of pocket to exercise stock options of this great company that we are very, very bullish on, say $200,000 or $300,000. We didn't make enough money from our salary, so obviously we can't afford it. But I'm coming from a wealthy family, so I can just ask my parents for the money, and you don't. And that's not fair. Equity right now is not equitable.
Yeah.
We worked exactly as hard. It's ours. We've earned it. It's ours. But how come? Because I can afford it because I am coming from a rich family and you're not. It means that it's not equitable, and this is something that should be fixed. And this is one of the bullets in our mission statement, that by empowering startup employees, we are making equity equitable. And I think this is very, very important, especially in times like this in Silicon Valley or in the tech ecosystem within the United States.
Yeah, I could see how, given that example, it can be very frustrating where you're excited about it, but you just don't have the money to come up with it. And then you're worried, let's say you don't come from a family of means. And even if you do exercise it, then you have to worry, what if it doesn't work out? And I kind of put everything into that hope and it's not panning out. So it's like it's a big risk, right?
I'll give you another example. This is I can't share the name, but again in 2020, sometimes employees approach us. They say, I need $200,000. I can afford out of pocket $40,000, and so I need you guys to just give me $160,000. Okay, sometimes they take the entire amount. Sometimes they do something out of pocket. So we were approached by, again, this developer, not a very senior developer. He was an immigrant from India. And he said, I don't have a dime to spare. I have literally nothing. But I need $300,000 to exercise my stock options. And if I will not get it from you, I will just forgo the stock options.
Oof.
Okay. We managed to get him the entire amount, $300,000. And 10 months later, the company that he left went public. These $300,000 became 4.2 million.
Nice.
That employee paid a portion back to the investors, which generated within less than a year a great return. Okay, that employee alone netted over $3 million, and that employee that came from India to the US and didn't have a dime to spare is now a millionaire, and he used some of this money to open clinics back in India. So it's like a circle of doing good in the world, that and a success story that we are very, very proud of.
That's a great story. What happens to this for, let's say, someone's leaving? Where do they put that stock, that private stock? Is it with you guys, or is there a platform where people could, leave their stock, buy and sell, trade private, private stocks that's not publicly traded?
There are platforms that enable us to do that. However, it's very, very complicated. The reason is that there are different covenants within the articles of a company that say, hey, if I own stocks and I want to sell the stocks, I need to get a CEO approval or a board approval. And by the way, even if you receive this approval, then they also need to approve the buyer, because it is going to be on the cap table. And by the way, even if they approve the buyer, then they have what they call a ROFR, or a right of first refusal. A right of first refusal means that if you have stocks in a private company and you would like to sell them, the current shareholders or the major shareholders have the right to say, no, I'm going to buy these shares. Or after you negotiated everything and you have the price and everything, they can snatch a deal. Or if they don't decide to do that, they might have what they call a call sale and say, if you are selling, I am selling as well to the buyer that you found. Okay? And this process involves lawyers and accountants and documents. It can be very, very long. So if you are an angel investor or a VC owning $5 or $10 million in this certain company, you will manage to make it work. It might take some time. But if you are an employee owning stock options and you have only a month or a couple of months or 90 days to figure this out, these solutions are not relevant for you because of the friction, because of the time it may take, and because many companies will just say no. Imagine a company with 1,000 employees and assume 5-10% churn a year. This is like 50 to 100 employees per year. If every employee will start trading their stocks, and they will just deal with who is coming to the cap table, and if they would like to do the process or not, it becomes too complicated. So they're not evil. They just say, we can't deal with this. So they reject it immediately. So employees currently don't have such solutions that work in scale. You can do one-offs, but not really in scale, and that is relevant for most employees.
So if somebody wants just small amounts of private, stock options or stock, can you handle that for them, or that's not really within your remit?
You are referring now to investors or to employees?
To anybody. So let's say they want to, your client companies who just maybe they're just looking to, hey, 100 shares, 50 shares, what have you.
Yeah, so our solution can our unique solution can handle small amounts, and starting from tens of thousands of dollars. These are small amounts in that case. Okay, both from an investor perspective, investors that would like to invest 10 or 20 or 30 or 50 or $100,000 in specific to fund an employee from a specific company to get the financial benefit or the returns of once this specific company will go public or exit, and the same for employees. So what we're doing differently in the market is that we are not looking at the private market, but we're looking specifically at employees. And our solution is structured specifically for employee needs, that we can provide the money they need in a timely manner, specifically tailored for their needs and their limitations. And we can support very junior employees that need $20,000, and we can support executives that are looking for $8, $9, or $10 million.
Does that mean, though, if let's say you're an employee of a company as a client of yours, and then you have an employee at B company, but each one would like to buy each other's stock, can you put that together? And then on scale, depending on all your different companies. So within your ecosystem, can that happen?
So I think it's the short answer is yes, but they no need to meet each other directly. Mm-hmm. If you would like to get access to the private market and to fund employee stock options, you can go, and you are accredited investors, because we are working only with accredited investors within the US. If you are an accredited investor, you can go to EquityBee.com, sign up, see the current companies that are available to invest in via the platform. And if there is a specific company that you would like to get access to, but is not available right now, you can add it to the wish list and we will get it for you. So yes, we also provide, we are a platform, two-sided platform. We have employees from one side and we have investors, a community of investors from the other side. And any accredited investor who would like to get access to private startup companies can sign up to EquityBee.com and start getting a deal flow.
So that's pretty cool. So I don't know if it changed, but I seem to recall the accredited investor has to have what, like a 250,000 net worth. I don't know if it changed over time or earn a certain amount of salary each year. Right?
So it changes from time to time. But within the US right now, it's the terms are that your net worth is $1 million or more, not including your main residence, or that your annual income exceeds $200,000 for an individual.
So if you meet that criteria, and admittedly, it's kind of like a pyramid. It's getting kind of narrow in terms of who has that kind of money to sit at the table. But they can go to your platform and look at the different offerings that you have and say, as you mentioned earlier, given that the market is soft and a lot of companies, startups have written down their valuation, they may say, this is a good time to buy, this company, this company, this company, and build a little portfolio if you have the means to do so, and get in. I don't want to say the bottom, but maybe get in what's at a very low point.
Yeah. Now we don't know where is the bottom, and maybe you are at the bottom already. But what we do know is that companies generate most of their value or their increase in share price while they're still private. So accessing startup companies or pre-IPO companies can be very, very lucrative. In the past couple of years since launching in the US, our investors on average, across all of the liquidity events that we've had, generated over 130% in ROI, in return on investment. So that's I think we are very proud of this. And this can be a very lucrative investment. And especially in times like this, investors should consider to diversify their portfolio with other forms of investments, not only public market investments, but also alternative investments, to invest in the private market. And that's why I'm so bullish on the startup ecosystem, and by funding startup employees.
Yeah. What you, and this is not a fair question for me to ask, but because I know you don't have a crystal ball, but any sense like how this is going to play out, in terms of you know, people figuring out, hey, am I going to exercise, or I'm just going to walk away from this because I don't know what to do. I don't have enough money. I'm just, when if you're a company, you're getting laid off and you saw the value of your stock going down and you're looking for another job, you're not the right headset to do this, but like, what do you see happening? Any takes on it from your vantage point?
Yeah, so I don't have a crystal ball.
Yeah.
And I don't know what how the next years would look like. I can say that nobody knows, right? Now the top experts and investors are saying 2023 and 2024 are going to be rough, and we will see the light late 2024, early 2025. Now, when you read these, projections, keep in mind that the best investors, the smartest people in the world, in March 2020, when COVID started, told us how everything is going to be over. And we all remember the Sequoia Black Swan letter from March 2020.
Mm-hmm.
And maybe 3 or 4 months later, the market started to be, we saw, the prices increase, and probably the best bulls market since we've ever seen for 2020 and then 2021. So nobody knows. What I would say to employees is that if you decide to exercise your stock options using your own capital, using your own money, your own savings, you need to understand that you're investing in one illiquid startup company. It's a very risky investment, so you should make a very educated decision if you're about to do that. If you can't afford it, or you don't wish to take that risk, or you simply don't have the cash, you should approach EquityBee. I'm a bit biased here, but a disclosure. Our solution provides you with the ability to get the money you need to exercise the stock options without taking any out-of-pocket risk. You will never need to pay anything out of pocket yet you didn't get from the company, or for your shares. So if you can't afford it, or you don't have the cash, or you can't afford the risk, that's the best solution that you have. And for sure, you should try this before simply foregoing your stock options, your hard-earned equity, because it's yours. You shouldn't, if you can retain it or some of it, you should. And given the fact that if you will not do that, you will for sure lose everything. So you shouldn't do that.
Yeah, that's great advice. Hey, just one last quick question. Have you ever thought about, or is it possible to put a fund together? So you take these different illiquid shares, but put it together so you diversify, so you have exposure to maybe the XYZ startup fund or the XYZ biotech or what have you, so people can get exposure across. So you're not just betting on one, and maybe you win, maybe you don't. You're, because like we talked about earlier, a little bit more diversified. Same way, like your dollar cost average, you kind of hedge your bets across a number of different. Is that in the works maybe?
Yeah, that's actually a great question. We have a product, we call it the VC5.
Okay.
There are the top 5 VCs that are most sought after by investor community. And if you don't want to invest in a specific company and you would like to invest in, we call this fund VC5, and this fund just invests in employees that left from companies that are backed by these top 5 VCs that are most sought after by investor community. And we offer this solution, and you can come up right now to the EquityBee platform, invest in the VC5 product, and diversify your portfolio by doing that.
So that's great. So if for people who are interested and want to learn more about, that fund, but understand how it all works at EquityBee, what's the best way to reach you guys?
The best way is to just sign up to EquityBee.com. We provide all the relevant information for you to make a decision either as employee or investor. And if you're not sure how to do EF specific questions, what to do EF specific questions, we provide you with the ability to schedule a call with one of our equity success managers or investor relations managers, who will be able to hold your hand through the process, answer all of your questions, and guide you through investing or exercising your stock options.
Well, that's great. That's all. And I'm so glad you took the time, Oren, to walk people through it, because I've seen so many folks, particularly, let's say with the, the blind platform, where people, now it's more public stock that they're talking about, but it's also startups and people, you don't know what to do. And sometimes you're afraid to ask. And like you said earlier, you could be the smartest software engineer or developer, but you really feel awkward asking these questions because no one wants to feel dumb. So they don't ask, and then they don't know what to do. So this way it makes it an easy solution. If you're not, how does this work? What do I do? How do I get the funding? How do I execute it? How do I make sure I don't miss out on that, 90-day window and so forth? So this way you offer that all-inclusive solution that they can come to you and they don't have to worry. And they're like, all right, help me out here. Here's what I got to do. I want to hold on to this. Maybe I don't have rich parents, and so I don't have the money. Can you hook me up? How do I do it? And this way, it just takes care of all of it for you. So you don't look back 5 years from now and go, oh my God, I could have had so much money in this and I walked away from it. Oh my gosh. So at least, so it gives you options, no pun intended, of like what to do.
Exactly. I've seen it happening so many times, of employees walking away because they don't have access, or they can't take the risk, or because simply they don't know. And we want to make sure to put an end to this, and to make sure that all startup employees will get what they've earned and participate in the success of the company they built, get their piece of the pie.
That's fantastic. Is there anything I didn't ask you, or that you'd like to tell the audience?
No, I think
we covered a lot of ground, which is good.
Yeah, we covered a lot. I really enjoyed our conversation.
Excellent. Well, thank you. This is like a great how-to, right? This is like a perfect, okay, here's how you do it, how it works, each step along the way to make it easier. So for a lot of people who just didn't know what to ask or afraid to ask, not sure what to do, I think it opens their eyes to say, all right, I get it. I could figure it out. And I'm going to get in touch with Oren.
I would just say one more thing, and that's for startup employees. Owning the right equity at the right time, owning equity, the right company, the right time can lead to a life-changing event. Equity is opaque and complicated, but it's not that complicated. You can figure this out. You should invest the time and educate yourself on how it works and what you deserve, to make sure you get what you deserve, what you've earned. So
perfect. That's a great way to wrap it. Thank you so much for your time, Oren. This is great. I think a lot of people are going to benefit from your knowledge, and hopefully you saved a lot of people a lot of money who may have just walked away from stuff. So I think you're going to do a good deed. And how great would it be? We'll have a bunch of guys, a bunch of women and men and everybody who like your Indian software designer, developer, walked away with millions and became a philanthropist and did good things. So, hey, maybe you could kind of have that whole army of people doing that and making the world a better place while everyone's doing well for themselves as well.
We are just getting started.
Excellent. Well, thank you so much. I'm so glad you're able to come on. This is so illuminating.
Thank you so much.
Excellent.
Jack.